the US 10-year yield, it just continues to drift lower. The US 10-year yield closed the week at 1.42%. I think we can contribute that to a number of things, such as waning inflation fears, and people are realizing that economic growth is going to be more muted as we recover out of COVID and things begin to moderate. We may not have that 6% growth next year, or maybe something more like 3%. So people are sort of tempering their expectations. What's really incredible before we get to the chart is that we called that on this show. We called it in late March. We also called for a rotation out of value and into growth, which is exactly what played out. So if you were listening, you were rewarded with some great knowledge.
What do you think, Kalen? The chart.
Yeah, I mean, I've been watching it the past few weeks, and it looks like it's just kind of tapering off, and all the stocks are just getting stronger and stronger. Like, I'm in a lot of tech stocks myself, and they're all setting up. I love all the patterns I'm seeing, all the technicals, like Amazon, Apple, like Nvidia, all these big charts, all these strong companies are just like, they just look incredibly bullish. Like they're in massive uptrends. There's no signs of slowing down, and like overall, I love all the charts I'm seeing myself.
You see on your end, like the tradings. I don't have too many thoughts on the bonds, except that I find it's interesting that between the 5-year and the 30-year, their charts look like almost identical, which is curious to me, because I'm wondering why the time frame. When they say bonds duration is what's important, right? So like, how come they're not kind of differentiating in terms of duration? Like 5 years and 30 years interest rates and inflation could have many, a huge effect or difference.
So I think that's completely structural, and we went through all of the structural factors on the last video when we were talking about the inflation illusion. But the interesting thing is, moreover to that, is that I'm noticing, like, obviously it's great when you have a steepening yield curve, but I'm noticing that the yield curve is starting to flatten a little bit, which from face value may not seem like a great thing, but if you're investing in growth companies like the companies that Kalen just listed, that's great, because if you're not going to have the really strong GDP, you're going to want to be investing in companies that are going to grow, even if the economy is not growing like 6%. So you want to be with the Facebooks, the Nvidias, the Amazons, the Apples, the companies that are going to provide like 20% year over year revenue growth, despite what the economic climate is. And I think, again, what we were talking about the other day is the TINA trade. Bond yields are so low. Where else are you going to get a return if the 5 years, 1%, the 10 years, 1.4%? You're not going to get a return anywhere. So I think the two are inversely correlated. So when I see everything starting to flatten, it's just another call to buy stocks, and we're just being validated by the bond market.
Mm-hmm. Yeah.
Did we actually say on the show those months ago that, because I know we talk in private, we're like
we talked like in private several times, yeah.
The inflation was kind of fugazi a little bit, like what the media was talking about it, and then we were saying like this whole energy thing, this rotation to the value might be a really bad move, and then we all took positions in growth. So it's kind of working out now.
Yeah, I mean, it's literally exploded. Nvidia, since we made that call, is almost up 100%. What's it up, like 80%? And I know, you guys are all in with me on that. But if you can pop up the 10-year again and just put it on like a monthly and really just zoom out, because in private, me and you were talking about this even before I joined the show, and it's just a series of lower highs and lower lows, and it's just a channel going lower. Like, even if you can go like multiple months, can you like a 2-month time frame or something else?
I can give you a year, 1 year bars.
Yeah. So this is just not a chart that I want to buy. Like, we're just in a secular, like, this is the new normal. Rates going lower. I'm not going to say rates are going to go negative. I'm not sure if I'm that crazy yet. Maybe one day I'll be saying that. But right now, I just think low rates this is the new normal. This is what life is now. And it's not even the 10-year. Look at the 30-year too, man. 30-year gives you even more insight.
Yeah, they're looking the same.
Mm-hmm.
It's COVID right there.
Is that the 30-year yield?
This is the 30-year, yeah.
Yeah. So that just tells a story there. I always say charts tell stories. And this is all because of technology.
Especially zoomed out this far. But what concerns me is like it looks like it's not just like a channel going down, but it's also like, have you noticed it's like a widening channel?
That's
So
in
it's
log?
like this is a log, yeah.
Okay, pop it
Yeah,
out of log. I'm just curious to see what that looks like.
oh, yeah,
That's probably real bad.
yeah. There you go.
Okay.
Actually, you're right. It looks more like a channel in the thing.
Mm.
Well,
Yeah,
it's definitely going to be interesting to watch. We rejected, what was it, the 200 on the 10-year? So I'm just curious to see what level that we're going to have to bounce off next and to see what
200
direction
week.
it's going to take.
Yeah, last week looks like we pierced 200 week and bounced off a bit, and we're coming back down probably.
Well,
No, sorry, that's the 200. That's the 50. My bad.
Yeah, so we're just literally in no man's land right now, just kind of consolidating between both of those moving averages and just trying to find a direction.
Which makes sense because the bond market would be kind of confused or iffy right now because you really don't know what's going on with inflation. We all thought they had an idea of where inflation was going, but now it's like not so clear.
Mm-hmm. Yeah, but inflation, even like compared to last year to this year, like the biggest thing that we were kind of talking about a little bit was it wasn't really a good correlation because if you're comparing, quarter two to quarter two or whatever you're going to look at those time frames, we had like a 3-month free fall. So if you're looking at that, if you're taking a time period in the middle of that market crash and comparing it to this year, those numbers, like they're not irrelevant, but they're really, really skewed, right? Like you almost have to take that big COVID drop out of the picture to get a better idea on the longer term of what real inflation is, and it's not nearly as bad as it actually showed in the numbers, and that's kind of what we were talking about.
I absolutely agree. And if you took the inflation stance when it was like, peak inflation, when they were talking about it on CNBC and TikTok and Reddit, you were buying Bitcoin at 60,000, you were buying gold at the peak, you were buying copper at $5. Like, you've really been burnt. So it just shows you sometimes you got to zig when other people zag. And sometimes you have to make your own point of view because, I always say when everyone's on one side of the ship sinks, right?